but I don't know how stocks work.
Oh, stocks. So stocks, I mean, they're kind of a centralized thing. So there's like big companies that basically hold them for you, but you can buy shares in a given company, and then if that company pays a dividend, then they'll send you a dividend for to eat your shares. But sometimes companies don't pay dividends and they just keep the money inside the company. However, people will still pay a higher price for those shares based on how much money is in the company. And one of the co-founders with Warren Buffett was Charlie Munger, and he said that Bitcoin was rat poison squared, which is basically saying it's really bad poison. And I don't necessarily agree with Charlie Munger on that, but I think in a lot of the meme coins and stuff, we see that you know some of this crypto stuff can be poison because it's a lot of speculation and not a lot of cash flow. See, with a business, when you buy shares, it's like you're buying a business that's running. And so if let's just say you pay $100 for one share for your company, you buy the whole company for $100, and every year that company produces $10. Your shares increase to $110, 120, 130, like every year. Or you have $100 share and then they pay you a $10 dividend at the end of the year. So they pay you $10 every year for holding that share of that company. You just get paid to be the owner. That's if everything paid out in dividends. But then what happens is maybe your share, instead of paying out dividends, maybe your share goes, over like a 10-year period, your share is now worth $200. And you need some of that money, so you sell your share for $200 in like 5 years or whatever it is. But say for example, you've got something like Bitcoin, right? And Bitcoin, we've had some good mathematicians like Michael Saylor. He'll go and he does some estimates on how fast Bitcoin is growing over like a 10-year period, over a longer period of time. And he says, over the next 10 years, he expects it to grow at about 30% a year. And then after that, at about 20% a year. So,
And $10 a year is not too small. In dividend, is it not too poor?
yeah, I
I don't
mean,
know.
it's all right. Yeah, like, well, if the money's being increased at 7% a year, you want to at least get 7% a year to break even, right? And then honestly, you do
Uh,
want a little bit more than that. So 10% a year is, to take the risk of holding a stock, you want you want to be paid a little extra. And honestly, you want to be paid a lot extra to hold something else. And see, because Bitcoin is so much stronger than most of the stocks in the stock market, I almost don't even look at them, to be honest. And a lot of them are way overpriced. Like, so, okay, I'm probably just going to confuse you worse, but you can play it back. So,
I will.
so if you've got one share in a company worth $100, okay, and it pays $10 a year, how long does it take to get your money paid back?
Um, if you have a stock worth $100 and
Mhm.
it pays $10 a year, how long will it take for what?
For you to get
To get your
your
money back?
money back. Yeah. We'll
It
just
will
pretend
take
it
10
paid.
years.
Yeah, it'll take 10 years. That's right. So, um, so one way that they talk about stocks is a price uh, PE ratio, and that share that we were talking about have a PE of 10, or in other words, 10 years to be paid back. Okay, is that easy enough to understand so far?
Oh, I understand now. But within the course of that 10 years, can you decide to like take out your money anytime you want?
Yeah, the market has so much capital in it. You can just put in a sell order and they'll just pay you. So maybe you hold it for 3 years, you get paid $30 in cash into your bank account, and then you still have a $100 share. in the stock market, and just one day you're like, you know what? I need my money back. I'm going to sell that share for $100, and then you put the order in and you get like 99.5%. You get like $99.50 because they take a fee, right, when you do a trade. And so and then you basically get your $100 back on the third year. Now, your money's not working for you anymore because you don't own that share anymore. Okay, but
Okay, okay, I think I'm getting it.
yeah,
Okay, so like if you want to like take for it to take 10 years, but at the end of the day you ended up taking it out in 3 years and you still have the stock, like it will still be counting, but you will be able to take out that $30.
what?
But it will still be counting, right?
No, so that's the trick. If you sell your share, you don't have it anymore. So now you have the $30 you earned for the first 3 years, and then you have $100 for selling your share, but you have no more shares. And so now you don't earn any more money because you just have your money back.
What if you don't have that $100 back? You just took the $30.
Yeah, if you just have the $30 and you still own one share, it'll keep paying you every year into as long as you live and hold it and that company survives. And they
Oh,
often survive about 30 years. But after that, every 5 to 10 years you should reevaluate if that company is going to be alive. You really should, because
okay.
what happens is like new technology comes along, and so like AI could kill Google, right? Like there's really a threat
Mm.
that AI is doing all this searching with or without Google, and people are stopping from using Google as much. And so Google, while they've had a monopoly on market, the new technology is taking market share from them. It's making things harder for Google to make their money. And they do have a lot of ways to make money, but
Oh, oh, and I normally see all those movies that they'll be like, the company share is rising, the company share is falling, this and that because of one or two news. So this is what they mean. Okay,
yeah, yeah.
okay.
So for example, let's say that company that you know, you bought one share in. Let's say the price for the day, some guy comes to you and he's like, "Today the price for those shares is $30." He's like, "I'll buy them or sell them for $30 today." Are you going to buy or are you going to sell more of those same shares? What do you think? Remember, they pay $10 a year usually.
And somebody wants to buy 30 shares
It,
and
they'll
sell
they'll
it.
they'll buy your share for $30 or they'll sell you shares for $30 today. Which do you
Oh,
want to do? Do you want
okay.
to buy or do you want to sell?
Uh, I want to buy
Why?
because if they succeed in buying other people's own, the value of mine will rise, right?
Well, maybe, or it might go down even further. However, it pays out a dividend, right? And it pays $10 a year. So your payback period, you get paid back in 3 years, right? If you buy them at this price.
Mhm.
That's way better price than what you paid before, right?
Yes. Okay. Okay. To understand. So what will you do? Will you
Well,
buy or sell?
it depends, right? If I think the company is going to be totally destroyed, I might I might sell my share for $30 and just take a loss, right? But if I think that that company is gonna keep cash flowing for the next 10 years, I'm likely gonna buy some of those shares because, you know, what is it? It's so if we go to the calculator, where are you? Here we go. All right, clear. So if we go in the calculator and we say $10 divided by $30 is 33% per year. So if I buy those at this price today, I'll make 33% a year every year for as long as that company is cash flowing good. So, and something you might want to look at is, does that company have any debt? And in the case of Google, if it was that cheap and they were cash flowing that good, right? Because maybe people are like, oh, AI is going to kill Google, but Google's cash flowing like a lot of money per share, but people push the price down because they're scared. When people are scared is your opportunity to make good money usually. And there is some risk, right? You could lose your money too. You have to kind of think about that. Am I going to lose on this one or am I going to win? But it's such a good price that my chances of winning are way better. And so, if it goes to $10 a share and you're like, but they're not going to go away, you really might want to buy because then you're making, you have 1 year to get it double. Your money gets doubled every year. It's really multiplying for you.
Think I'm getting it. I think I'm getting it. So, for example, if normally a share is $100, and then because of fear, they push it down to $10, you have a higher chance of doubling down on your money in 1 year if the company survives. Okay, I'm
Yes,
getting it.
that's right.
But you still have a chance of losing. So it's high risk, high return.
Yeah, it really is. And, maybe it's a cotton company and they had a bad storm this year. This actually really happened in an investment a couple of years ago. A guy invested in a company that, because there was a bad, like bad weather, they were going to have a couple of years of like, recovering from the bad weather. But the guy kind of looked at the company and did the math and figured out that they were still going to be around and cotton prices were going to normalize. They were really high for a while, so it wasn't profitable. So everybody dumped the shares. They're looking at the next month if it's going to be positive or negative, and they saw it was going to be negative, so they just dumped it on the market, and so it pushed the price way down. And so this guy figured out, he's like, is this going to be around still? And basically the answer was yes, it is. And they're going to survive it. They have enough money to survive for a year or two or three. So he bought up and then, waited a couple of years. And sure enough, cotton prices went back to normal eventually. And there you go. And then the value comes back up because they're like, oh, look, they're making the profits again. And the money rushes back in from all these big firms and stuff. And so understanding what's happening to a company is really important. Now, there are some other risks, like CEOs sometimes will do mergers or something. There are ways that your value can get destroyed in a company that are clever things that some CEOs do. So you have to kind of um, you have to look to make sure that the leadership isn't doing too naughty of stuff or that they don't have too much debt. One of the reasons I look at the debt on MicroStrategy is because their assets just need to be a lot bigger than their debt so that they don't have a lot of risk. This was a basic lesson in shares and valuations, and I think you have leveled up a little bit. You're now a beginner and you kind of get the basics.
Congratulations to me.
Yes,
Thank you,
congratulations to
Amon,
you.
for taking me through it.